Most people spend years trying to build the perfect portfolio and end up with something they cannot explain. That is usually the first sign it is not a good portfolio. They own too many funds, they chase too many opinions, they add things because the internet made them anxious, not because the structure required it, and by the time they are done, they do not have a strategy. They have clutter. I have spent a lifetime studying capital allocation, and one thing becomes more obvious with age, not less. Good investing usually gets simpler as wisdom improves. The public likes complication because complication feels intelligent. It sounds informed. It lets people pretend that more moving parts must mean more precision. Usually it means more confusion. That matters most in retirement, because retirement is where confusion becomes expensive. If you are 32 and your portfolio is a mess, you still have time to repair the damage. If you are 62 and your portfolio is a mess, your repair window is dramatically shorter. That is why I want to begin with a number that should bother you. The average American family has around $334,000 saved for retirement. To a young person, that may sound respectable. To a retiree trying to live on it, it can feel like a cruel joke. At a 4% withdrawal rate, that is roughly $13,000 a year. That is not retirement money. That is not freedom. That is pressure wearing a retirement label. That is why the portfolio question matters so much. Not because the market is a game, because the market becomes the machine that either carries you or exposes you. And if you build that machine badly, retirement becomes a long negotiation with fear. Now, most people hear the phrase simple portfolio and they make the wrong assumption immediately. They assume simple means weak. That is not how I think. I think simple means every dollar has a job and every job is necessary. That is the mother line I want you to hold all the way through this story. A strong retirement portfolio does not need more funds. It needs clearer jobs, 3 jobs, anchor the money, grow the money, pay you while you wait. If those 3 jobs are covered intelligently, a great deal of the noise disappears. That is why I find the idea of a 3-ETF portfolio so attractive when it is built correctly. Not because 3 is some magical number, because 3 can be enough if each position is doing something distinct and useful. The old Boglehead structure understood something important long before the financial industry figured out how to monetize complexity. Own the broad market, keep costs low. Do not trade your life away trying to outguess millions of other people every week. That remains sound. But the world changes. And when the world changes, the jobs in the portfolio may remain the same while the tools that best do those jobs evolve. That is what this source material is really trying to say underneath the ETF names. The 3 jobs still matter. The tools have shifted. That is the real story. The first job is the anchor. Every portfolio needs one, not the sexiest fund, not the one your cousin brags about, not the one that had the best one. Your return while the market happened to be in a very specific mood. The anchor is what lets you stay sane. It is the part of the portfolio that says, I own the broad productive engine of the American economy, and I do not need to guess which individual company will dominate next quarter. That matters enormously. People underestimate how much psychological energy is saved when you stop pretending you need to pick every winner yourself. I learned a long time ago that the market is a brutally efficient machine for humiliating ego. You can spend years believing you have a gift for choosing the future, and then one cycle can remind you that what you had was a run of favorable conditions and too much confidence. That is why the anchor matters. It protects you from your own need to be clever. The ETF filling that role here is VTI, the Vanguard Total Stock Market Index Fund ETF. I like it because it does exactly what a proper anchor should do. It owns almost everything. Not one theme, not one sector, not one story, the whole U.S. stock market. Thousands of publicly traded businesses in one simple structure. When you buy it, you are not saying, I know which company will win. You are saying something. I believe productive American enterprise in aggregate and over time remains one of the strongest compounding machines available to me. That is a very different statement, and it is usually a smarter one. I want you to imagine what this means in practice when technology slows. Something else may carry more of the load. When healthcare stalls, consumer businesses may continue doing their work. When one fashionable corner of the market gets crushed, another may remain quiet and resilient. The whole market rebalances itself over time, and you get the benefit of that without having to play portfolio whack, a mole with every headline. That is what the anchor is for, not to be the fastest thing in the room, to make sure the room does not collapse around you. This is also why it stays close to the original Bogle spirit. Jack Bogle understood that most people do not need more brilliance. They need lower cost, broader ownership, and fewer opportunities to sabotage themselves. VTI gives you that. It is cheap, it is broad, it is honest. And over long periods, those qualities matter more than temporary excitement. The numbers in the source material are useful here, not because they promise the future exactly, but because they remind you what long-term discipline can look like when it is allowed to work. A one-time $10,000 investment left alone across decades can grow into something far larger than the starting number suggests. Because the compounding is doing the heavy lifting in the background while you are busy being human. That is what a real anchor does. It lets time do something impressive without demanding your daily emotional involvement. Now, an anchor alone is not enough. It makes the portfolio stable, but stability alone does not build real wealth quickly enough for many people. An anchor protects. It does not accelerate. That is why the second job matters. The growth engine. This is where most investors get themselves into trouble because they misunderstand what growth exposure is supposed to do. They either avoid it because volatility scares them, or they overdose on it because stories excite them. Both mistakes come from the same error. They treat growth as entertainment rather than as a carefully sized engine inside a broader machine. The original Boglehead template used international stocks in this slot that made a lot of sense in a different era. You wanted another growth stream outside the United States. You wanted diversification across borders. You wanted a hedge against one country's relative weakness. That logic still has merit in the abstract, but the practical world has changed in ways many investors do not fully appreciate. The largest American companies are no longer simply American businesses serving Americans. They are global operating systems. Their products, software, advertising, data centers, and semiconductor ecosystems reach into every major market. When you own the most dominant technology businesses in the United States, you are not making a narrow domestic bet. In the old sense, you are owning part of the world through the companies currently shaping it. That is why the source upgrades the international slot into QQQ. And I understand the reasoning. QQQ is not the whole market. It is a concentrated growth engine built around the largest non-financial companies on the NASDAQ. That means semiconductors, cloud infrastructure, software, artificial intelligence, digital commerce, biotech, and all the machinery that increasingly shapes how work, communication, logistics, and profit actually happen. This is not a sleepy fund. It is an engine. And engines behave differently from anchors. They run hotter, they move faster. They also break your nerves more often if you do not understand what they are there to do. That is why I would never put QQ in the portfolio and then pretend it was there to make you feel comfortable in every market. It is not. It is there to pull the machine forward. That means volatility will be part of the price. You do not get the long-term acceleration of growth assets without periodically being asked whether you actually deserve the future return. That is how markets work. QQQ can fall harder than VTI in bad periods. That should not surprise you. The companies inside it are higher growth, higher expectation, and more exposed to revaluation when rates or sentiment shift. But what history has shown again and again is that when these companies come back, they often come back with force because they are not marginal businesses hoping to become relevant. They are already central to the modern economy that matters. The source points to the last decade of performance to illustrate this. A fund that has historically grown much faster than the broad market over a sustained stretch naturally changes the mathematics of long-term wealth if you are patient enough to survive the ride. And that is the operative phrase, patient enough to survive the ride. Because every growth engine looks obvious in hindsight and emotionally difficult in real time. That is why sizing matters. QQQ does not belong in the portfolio because it flatters your optimism. it belongs there because if used correctly, it gives the whole structure a chance to outrun the sleepy average. Now we come to the third job, and this is the one that turns a portfolio from an abstract future number into something that feels alive today income, not fixed, frozen, lifeless income, living income, growing income, income that arrives while the rest of the machine keeps compounding. That is what the third slot is supposed to do. The old Boglehead answer was bonds. Again, perfectly sensible for a long time. Bonds provided stability. They provided predictable interest. They softened the ride. But the world we are in now has made the limitations of that slot much more visible. A bond pays what it pays. That can be useful. It can also be disappointing. In an inflationary world, a fixed payment is not a full solution. If your income does not grow while your costs do, you are standing still or moving backward with better paperwork. That is why the source replaces the traditional bond slot with SCHD, the Schwab U.S. Dividend Equity ETF. I understand this move as well, because what SCHD gives you is something bonds struggle to provide. Current income and the possibility of growing income that is a crucial distinction. It screens for quality dividend businesses, strong balance sheets, consistent payouts, companies that have demonstrated they can share profits with owners across cycles rather than only in good moods. That means you are not simply lending money and waiting for the coupon. You are owning companies that can potentially increase what they pay you as they grow. That changes everything. Income that grows is one of the great hidden luxuries in investing. A retiree does not merely need checks. He needs checks that do not become weaker each year in real terms. A patient investor in accumulation years does not merely need yield. He needs an income stream that can be reinvested into a larger and larger flywheel over time. That is what SCHD can help do. It is calmer than the growth engine, richer in income than the anchor. And psychologically very useful because it pays you for waiting. That last point matters more than people admit. A lot of investors fail because nothing in the portfolio gives them emotional reinforcement. They are always waiting for appreciation, always waiting for the chart to validate them, always staring at a number that moves around and asking whether the whole thing is working. Dividend income changes that experience. It reminds you that ownership is productive. You are not only watching prices move, you are being paid. Then if you reinvest the income, the flywheel starts building itself. More shares, more dividends, more shares, more dividends. That quiet loop has made many people richer than their personalities would have allowed if left unassisted. Now, I want to be honest about the shift from bonds to SCHD because honesty matters here. This move gives you more upside and more inflation defense through growing corporate payouts. Yes, it also gives you more equity risk than a true bond allocation would. That is not a flaw if you understand it. It becomes a flaw if you call it safe in the wrong way. This is not the same as fixed income. It is a better income engine for some investors in the world we have now, but it still lives inside equity markets. That means the portfolio becomes simpler and arguably stronger in growth and income characteristics, while also becoming more reliant on your ability to tolerate stock market behavior. That is why the portfolio has to match the person always. A portfolio that is perfect on a spreadsheet and impossible to hold emotionally is not a good portfolio. It is a stress test disguised as a plan. Now let us put the three jobs together. VTI anchors, QQQ accelerates. SCHD pays you while the rest compounds. That is the machine. And it is a good machine because each part is distinct. The anchor keeps you tied to the broad productive economy. The growth engine gives you a concentrated exposure to the dominant forces of modern business. The income layer gives you cash flow and a psychological ballast that many portfolios lack. That is why the equal weight structure in the source works so well as a teaching model. It lets each job speak clearly. 1/3 to the anchor, 1/3 to the accelerator, 1/3 to the payer. From there, the math becomes a reflection of the jobs. The combined dividend yield is enough to matter, not enough to distort the whole portfolio into an income-only machine. The combined growth rate is strong enough to create real wealth if left alone. The combined identity is balanced enough that no one part is being asked to do everything. That is what I like most about it. No fund is being forced into a job it was not built for. And that is a useful principle beyond ETFs. The entire problem with most bad portfolios is that they ask one asset to do too much. A person buys one fund and expects growth, stability, inflation protection, income, emotional calm, and retirement safety all from the same place. That is not how good architecture works. You need specialization. Now, let me make the source S projection logic emotionally real, because the numbers are impressive only if you understand what they really mean. A 1 times $10,000 invested and left alone can grow to a sum that feels disproportionate to the initial act, because compounding is not linear. It does not reward your impatience, it rewards your endurance. The first years feel underwhelming. Then the curve begins doing what most human beings are too emotionally restless to wait for. This is why the source keeps comparing the long-term result to the average retirement savings figure. It is trying to show you something brutally simple. Average behavior produces average retirement. Consistent behavior inside a strong compounding structure can produce a very different ending. And when the source shows the $10 a day scenario, that is what it is really proving. Not that any projection is guaranteed, not that life will move in a straight line, but that ordinary daily consistency, when fed into a properly built machine, can eventually create an outcome that looks impossible to someone who never started. That is one of the most important truths in all of investing. Wealth often feels impossible right up until enough consistent years have passed. Then it feels inevitable. That is not magic, it is sequence. Now, every portfolio like this needs rules, and the source gives 3 that I think are exactly right in spirit. First, 1 ETF per job. I like that rule because duplication is how clean structures turn into clutter. People think adding more funds always improves diversification. Often it improves confusion. If one fund already covers the broad market, why are you adding 2 more broad market funds that mostly tell the same story? If one dividend fund already fills the income role, why add another 5? Because the names sound reassuring. 1 tool per job, that is discipline. Second, know your goal. This is where age and temperament enter the room, a 28-year. Old can lean harder into growth because time is the greatest volatility absorber ever created. A 62-year, old approaching retirement may want more income and steadier ballast. Neither person is wrong. What is wrong is copying someone else's allocation without copying their time horizon, emotional tolerance, or financial purpose. The portfolio must fit the life that is non-negotiable. Third, stay consistent. This is the hardest rule because it asks you to remain reasonable during periods when the market is trying very hard to make you feel unreasonable. Anyone can buy when everything is clear. The payoff goes to the person who keeps the structure intact when headlines get loud, who reinvests when others are paralyzed, and who understands that a good portfolio cannot show its full character if its owner keeps interrupting the compounding. That is why I often say the investor's biggest enemy is not the market. It is the version of himself who appears during stress. Now, if I were building this for myself in the way the source frames it, I would not think of it as 3 ETFs. I would think of it as 3 promises. The first promise is, I will own the broad productive machine. The second promise is, I will reserve part of my capital for powerful long-term growth, even when that growth is temporarily uncomfortable. The third promise is, I will receive and reinvest real cash flow so that patience gets rewarded in visible form. That is a much stronger way to hold a portfolio because it makes the structure ideological instead of fashionable. You stop asking what is hot, you ask whether each job is still being done. That is a better question. Now let me tell you where people still go wrong with a structure like this. They start tinkering. The anchor lags in 1 year, so they replace it with something flashier. The growth engine has a bad stretch, so they decide the future is canceled. The dividend layer looks boring next to some new excitement, so they abandon the thing that was meant to make waiting easier. This is how people ruin good plans. not by lacking information, by lacking steadiness. And this is why the source is so insistent about the daily discipline angle. $10 a day is not just a math example, it is a behavioral example. It shows that the real power is not in finding a magical starting amount, it is in feeding the machine without interruption. That is how average people do extraordinary things in markets, not by brilliance, by refusing to stop. So what do I think the real lesson is here? It is not that these three ETFs are the only acceptable answer forever. It is that most people need a portfolio that is simple enough to explain, strong enough to survive, and clear enough that each part has a visible reason for existing. That is what this structure gives you. A reason, the broad market reason, the aggressive growth reason, the growing income reason, 3 jobs, 3 tools, 1 machine. And if you build it early, fund it consistently, reinvest the cash flow, and resist the human urge to turn everything into a drama, you can end up in a place very far from the average. That is what the source is really trying to pull people toward. Not just better ETFs, better architecture. Because average retirement does not come from bad luck alone. It often comes from bad architecture. Too much clutter, too little growth, no income design, no patience, no consistency, and good retirement or good long-term wealth more broadly comes from the opposite. Clarity, growth where it belongs, income where it belongs, patience everywhere. If you remember only one thing from me, remember this. The smartest portfolio is usually not the one with the most opinions inside it. It is the one where every dollar knows its job. That is how wealth compounds. That is how confusion shrinks. And that is how an ordinary investor can begin turning small daily effort into something that years later looks a great deal like freedom.